and we'll get going.
Ready.
Good evening, folks. Thank you for joining us. My name is Mike Zlatnik. I am the CEO of TF Management Group. We also have Clay Malcolm, Director of Business Development. Clay, correct me if I got your title correctly, from New Direction IRA.
You got it.
Yeah, Clay and I have known each other for a number of years. I personally use New Direction IRA and love them. They're a phenomenal IRA custodian. There are many other great custodians, to be fair, but I personally prefer New Direction IRA. And we came up with this wonderful idea to do a joint webinar. So, Clay, you have the floor. It's a pleasure and a privilege to have you.
Great. Hey, thanks, Mike. It's good to see you as always. And one of the things that is really nice about knowing Mike and knowing his background is that because New Direction IRA has some limitations in terms of the way that the amount of information that we can give you, you know, sometimes we're able to do education events with Mike where he's developed something innovative or, you know, has an insight. So it's really nice for me to be able to share the IRA part and then have Mike or, you know, any other expert be able to share their part. So I appreciate you, Mike, for putting this together, and let's go ahead and set the stage for what we're going to talk about today.
Thank you, Clay.
So one of the things that I'll just mention is that all the information that I'm going to give you is for education purposes only. At New Direction IRA, we actually don't give tax, legal, or financial advice. Really, our job is to make sure that the IRA, whether it's a traditional or a Roth, SEP, simple, HSA, individual 401k, is documented properly so that the IRS will give that account the tax benefits that are associated with it. So anything that the account holder does is really at their own direction. And so we don't recommend any particular vendor or asset class or any investment strategy, really. And we really encourage you to bring your financial and real estate team or whoever it is that you trust with you, because you're the one who's going to be making the calls. And so we're really just there to document it and make sure that it works out okay from an IRS perspective so that you get to keep the tax benefits. So that's our role in the equation, so to speak. And self-directed IRAs themselves are not an actual account type. So the account types are the ones that you know. So traditional and Roth, HSA, the things I just mentioned, SEP, simple, and individual 401k, those plans, their contribution rules, their distribution rules, their tax advantages, all of those stay the same as you are already familiar with. The thing that's different when you have a provider that handles alternative assets is that instead of your IRA being limited to publicly traded securities, it means that your IRA can invest in all the things that the IRS allows. So that could be real estate, lending, private equity, precious metals, so on and so forth. And one of the things that really caught my attention about what Mike's going to talk about tonight is he kind of, you know, uses a couple of different techniques there to achieve a particular goal. So I thought that was, you know, kind of an interesting way to approach the rules. And one of the things that I'll encourage you to do is understand the rules of the account type and take advantage of them according to how you're going to invest, because it really is a match between the account type and the investment. But all of these account types can invest in alternative assets. And if you're talking about real estate, the thing I want to mention from a conceptual basis is that the IRA is going to own one of a few things. So three, actually. It's either going to be a thing, so piece of real estate, piece of gold, something like that. It's going to be a note of some sort, so some sort of lending instrument. Or it's going to be private equity, meaning that you invested in a company, whether it's a LLC or a C Corp or whatever it is. And certainly the more common understanding of this is that, you know, your IRA would invest in stock at, you know, Apple or GM or something like that. So that's really the same idea, except that the IRS will allow you to also invest in private companies. So it doesn't have to be publicly traded. But at its core, you're going to own one of those three things, the IRA. So what we're really talking about today is that the IRA, once money is contributed to it, instead of it buying publicly traded securities, it's going to buy something that's either private or alternative or something like that. But the structure is exactly the same. The earnings are tax deferred and distributions are according to the rules of the account. So it really, all we're really substituting is the assets that money buys. And of course, once you've contributed to a tax advantaged account, in no small part, your task is to get that money to make money, because most financial professionals will tell you that the advantage of these accounts is that because they're tax deferred on their earnings, they can compound much faster. So understanding those basic principles, let's move forward in terms of what the possibilities are from an IRS perspective. When your IRA invests in, and I'm going to focus now on real estate, it can be almost any asset. So commercial, residential, it can be ag land, pre-developed land, and any financial instrument that is associated with real estate, which I think Mike is going to get into in more detail. So an IRA could purchase non-performing notes or a trust deed or something like that. So all of those financial instruments that are associated about or with real estate and the way that it is transacted are all available for your IRA. So the IRS gives you a lot of different assets that you can get into from an IRA perspective, and you can combine it with the tax advantages of the account. The other thing I'll mention is that if your IRA is going to buy, and now I'm going to talk a little bit more specifically about UBIT because it's the topic of this presentation. If your IRA doesn't have the full purchase price, it can actually use debt in order to increase its buying power. So debt is allowed in IRAs. Now, there's a few things to know about that. One is that not all lenders will lend to IRAs. And in no small part, that's because it has to be non-recourse, quote unquote. And what that means is that the account holder, as well as some family members, will not be able to pledge their personal assets in service of that loan. So if there's default, the lender is really acknowledging that they will take the property, but they can't come after your personal assets nor any of the assets of those disqualified persons. So it's a little bit different business proposition for them because of the no personal guarantees. And from an IRS perspective, there's this interesting kind of dynamic. So the IRS is going to, when you contribute money to one of these accounts, they're going to give you some tax benefits that are different than you personally. And personally, if I could get my IRA's tax benefits to apply to my personal finances, I'd really love it, but that doesn't happen. So when I contribute money to these accounts, I'm going to get some tax benefits from the IRS, but there is a tax event associated with it. It's either at the end of the process with traditional IRAs and most 401ks and so on and so forth, or at the beginning of the process with Roth IRAs. But understand that the IRS has a tax, stake in the process that's occurring. And so because of that, they're going to track what happens in your IRA. And one of the things that is an offshoot of that is that if you are going to use money that you never had to contribute to your IRA, in other words, debt, so your IRA goes to a lender, it gets a loan, you never contributed that loan money to your IRA. And so one of the things that's going to happen is that the IRS is going to say, okay, well, for the privilege of using other people's money to buy an asset that is going to fund your IRA, and make no mistake, your IRA may make a lot of money based on money that you never had to contribute, right? You took from somebody else. Then UBIT, unrelated business income tax, may apply. So it's a cost of doing business with other people's money. And there's an interesting thing. There's actually 3 instances when this occurs. So your IRA may incur UBIT on 3 different fronts, so to speak. If your IRA uses debt financing, then the ongoing annual returns, usually rent, could be subject to UBIT. And at the bottom there in the red bar, when your IRA sells a property that it has outstanding debt on, there still may be UBIT for that, the profits of that sale. And One that we're not really going to talk about a lot today is that if your IRA owns a business that is not housed within a taxable entity. So in other words, your IRA owns a, I don't know, a bicycle
McDonald's.
shop. Right.
McDonald's, that is not a C corp.
Right. McDonald's, it's not in the C corp. The business tax gets taken care of at the IRA level. But today we're going to be focusing on the debt financing part. And so it's the debt finance either on ongoing rents or at the sale if there's outstanding debt. But the thing I will mention to you, and this is the interesting part of it, is that it is only on the percentage of the net profits that are associated with the debt financing. So you do get to take some deductions, and you get to whittle the gross amount of profit down to the net profit before you actually have to pay the UBIT. And the way that I'll just give you a super quick example here. So if your IRA owned property has some debt on it, there's $10,000 gross rental, and a 990T is actually the form that your IRA files for its taxes, and it is separate from your personal 1040 or your personal taxes. But in this particular case, let's say there's 60% outstanding debt. So of the 10 grand, 6,000 of it is going to have some UBIT calculation. Now 4,000 of it, because it's money that's attributed to the money that you contributed to the account, there's no UBIT calculation on that, but the net profits that are associated with the 60%, absolutely. So this is completely hypothetical, by the way. So let's say you get 2,500 off on 60% of the expenses and depreciation on that property. Every year you get $1,000 free for the IRS. So your taxable UDFI, which is unrelated debt financed income, which produces UBIT, goes up against the trust and estate rate. And so what would happen is your IRA would pay the IRS, and I took the 2014 rate. I really need to update that. And 2014 trust rate chart, it was $375. So you would have to pay that, your IRA would have to pay that to the IRS, which, if you're like me, anything you can keep from the IRS is a boon. We like that. So you still, the debt financing still may make sense for you on when you crunch the numbers. I'm not saying that there's anything necessarily wrong with it, but you're still chipping away money to the IRS for the use of other people's money in this scenario. So this is just a sample to give you an idea of when the IRS expects UBIT, unrelated business income tax, to be paid from your IRA. Now, all these things notwithstanding, the idea that your IRA can purchase and benefit from real estate is, I don't mean to diminish that at all, and it's really easy. So all you would do is open an account with a self-directed IRA provider like us. You fund the account, and that can be from a few sources. So typically a rollover from an old 401k or a 457, 401a, defined benefit plan, whatever it is, or a transfer from a like account. So if you already have a traditional or a Roth, and then you can always make contributions as well, because the accounts with us, traditional Roth, HSA, they act the same as the IRS. It's only the assets that really change. So once you have some money in that account, then you choose your investment. You talk to your financial team and anybody who is your advisor, and you decide what assets you want, and then we help you execute that purchase. And your IRA pays the money for the closing of the deal, and it also receives all of the proceeds, just the same way as it would be with a publicly traded security. So it really is the same system, except that you get to invest in alternative assets or private assets. So if you think that your returns are better there, then that could make some sense for you. And this is our contact information. And really the only reason I'm showing you this is because we want you to consider us as an ongoing source of information. I went through this very quickly. This was just a sketch, but I did want to set the table for what Mike's going to talk about. And I also know that if you have more questions, we understand that we're there for you. So if you want to email it, it's info@ndira.com. Our website has some pretty pretty good information, pretty detailed information. So you can check that out, or you can just give us a call to the office. We are headquartered in Colorado and would be happy to talk to you. So as that introduction kind of gives you a sense of what happens with UBIT and real estate investing and so on and so forth, I'm going to go ahead and pass it over to Mike so that he can talk about the strategy that he has kind of figured out. Because one of the interesting things is that because we can't give financial or tax advice and that kind of stuff, often what we're really doing is transmitting when we can what we've seen account holders do. And so Mike has a way that you can, a system that you could actually adopt. So I'm going to go ahead and give my screen over to Mike and let him take off.
Thank you, Clay. I wanted to say that I've worked with you guys for a number of years, and you are phenomenal. And your process, your team, your ease of submission of funding requests, and everything has been A+. So there are many other good custodians, and I don't want to endorse any custodian, but my personal experience with you has been an A+. So that's my 2 cents on working with you. Let me now go to the presentation. Okay, folks, so let me get going. So the purpose of this presentation is to give you an advanced technique. This technique is very powerful, has a couple of elements, and hopefully you will enjoy the benefits of it. And so the primary purpose is how to invest self-directed IRA funds into real estate with mortgage leverage, what Clay just talked about, for example, 60% leverage, and avoid UBIT tax. Disclaimer, this presentation is for educational purposes only. We're not attempting to sell security or selling anything else. We give no legal, accounting, or any other advice. I'm in the private lending and fund management business, and I'm just sharing my knowledge and experience with you. And prior to making any investment decisions, please consult your professional attorney, CPA, and whatnot. And the funds that we manage, TF Temp Opportunity Fund and TF Investment Fund 2, can only be offered by private placement memorandums and to accredited investors only. If you have any interest, please contact me, and we can only discuss those funds, and offering can be done through PPM. Again, this is not any kind of offering. This is just educational content. A couple of words about us. I've been a fund manager since 2009, running at this point 4 funds. Our flagship fund is Temp Opportunity Fund. We also have a very active fund, TF Investment Fund 2. Our focus, we have 2 lines of business: short-term bridge lending, hard money lending for fix and flip projects. We also invest in a long-term equity with a strong value add, including predictable cash flow and forced appreciation. I do have a book published. This is How to Choose a Smart Real Estate Investment Fund. It has all kinds of questions, how to help folks understand private funds. And I recently started Big Mike Fund podcast. So there's a website, bigmikefund.com. You're welcome to start listening. Hopefully you'll find the content educational and helpful. And just very quickly, we don't broker deals. We don't collect anything up front. If we work with you, we always get paid on the back end when you get repaid. All our deals come, when we work with investors, they all come from the same deal flow. We underwrite them. We never offer folks anything other than what we like ourselves. Same pipeline. And if you like the concept of the fund investing, we could chat further. Again, I'm not offering anything, but we manage a few funds, diversified funds. One is a mortgage pool, one is a growth and income fund. So we can talk more about that later. Okay, so let me just jump to the meat and potatoes of this presentation. So in my opinion, the best way to invest from an IRA is to invest in the secure promissory notes and buy options. So you could have control over real estate you could collect great return without owning real estate. There's nothing wrong fundamentally with owning real estate in your IRA, except for the fact that you may be subject to UBIT. So when you're considering an investment into real estate, I'm going to give you a different perspective. The perspective is that you can lend money on a real property and collect high interest rates income, and also you can control all the upside through having an option on the property. And both of these instruments enable your IRA to collect income and control the upside essentially with no UBIT tax at all. So let me continue. So UBIT is also in some cases called UDFI, and in some cases called UBTI. You will hear these terms. So unrelated business income tax, unrelated debt finance income, and unrelated business taxable income. So all these terms that stand for the same thing. If your IRA, as Clay mentioned, is an investor into an operating business like McDonald's, if IRA owns a McDonald's and it's not a C Corp, it creates UBIT tax on the income. And also it happens very, very often when you buy real estate or you buy any asset and you have leverage. You basically borrow money, you borrow the money that doesn't belong to your IRA, and you benefit from that, and you increase the income on the property and you increase depreciation because you borrowed the money. So IRS wants a fair share. And unfortunately, the tax rates the IRS assesses on the UBIT tax are extremely high. They jump very, very quickly. So if you make a little bit of money in your IRA, you're already subject to high taxes. And if you start making a lot of money, you're subject to much higher taxes. And the current tax cut that has just been implemented does not discount UBIT taxes. It only reduces the taxes for normal interest rates. So please learn more by going to IRS. Here's a website, and you could learn a little more about that. And New Direction IRA has a wonderful information on the same subject on their website. So here is an approach and a system. And what's interesting, I was just at a mastermind event, and I encountered a situation where somebody almost asked me for this. And let me just talk about the technique, and I'll reverse the position. You'll understand the power of this method. So the method is fairly simple. Instead of buying a property into an IRA and getting mortgage financing, the technique is to find a financial friend with a good credit who can get a mortgage. That financial friend cannot be a prohibited party. So you, your spouse, your children, your grandchildren, your parents, your grandparents are all prohibited from doing business with your IRA. It would create a prohibited transaction. So you cannot do it with linear ascendants or descendants or your spouse. But your financial friend could be your brother, your sister, your uncle, your cousin, just a friend. There's nothing wrong with having a good friend who would like to do this. So when you buy a property, what you're doing is you're making a loan from your IRA. The first lien loan will come from a conventional mortgage. So your financial friend buys a property in his and her name or in an LLC name and gets a conventional first lien mortgage. Your IRA at this point can make a second lien loan for all the funds necessary for the closing. So in a simple example, if $75,000 mortgage is a first lien mortgage, your IRA can lend $25,000 down payment as a second lien plus $5,000 more, total $30,000 as a second lien on the property, and your financial friend can buy the property for $100,000 and have $5,000 closing cost. So this is a very powerful idea where your IRA comes in as a second lien or second mortgage holder and holds the debt on the property instead of holding the equity. And once the financial friend completes the purchase of the property, your IRA can buy an option on the property, and the option could be $1,000 to control virtually all the upside. Let's just say the purchase of the property was $100,000. Your IRA could have a 30-year option for $1,000 cost with a strike price of $105,000. It works the same way as options work in the stock market. So all this means is now your IRA could buy the property from the current owner, your financial friend, for the next 30 years for $105,000. Even if the property appreciates to $250,000, it would still, the option will control essentially all the upside in the property. And while I'm here, I'm going to give you an example of what just happened. I was at a conference and I was talking to very bright group of folks. One of them said, "How do I have turnkey properties, this wonderful $100,000 property, have $75,000 mortgage, and I want to exit the property. But if I sell, I have to pay closing commission. There's going to be transfer taxes, this and that. It's going to be cost, and I'm not even going to get a great return of the of capital." What's interesting is if that's your financial friend and you have money in an IRA, you could say, let's make a deal. Let my IRA lend you the money that you're trying to take out of that property as a loan and record a second lien on the property. And concurrently, my IRA will buy an option, exactly this technique. And there's definitely need for this because people trying to sell some of these properties that they've held for a while, and they have great mortgage in the property. That's another benefit. In a second, we'll get there. But when somebody has a 30-year fixed rate mortgage at a rate, at a great rate, most likely even below the current rates as the rates have gone up, that creates an opportunity for IRA to come in a second lien position plus the option and take control over the property with great existing first mortgage. So there's a lot of power to this technique. Let me continue. So what happens? So this is a picture. So it's a $100,000 purchase. There's a first lien mortgage that your financial friend, or in the case that I just described, where a person that I met, and I actually know that person really well, she could be a financial friend. She had a great mortgage, and the mortgage could be, this is an example, of $75,000, which is 75% LTV, at 4.75% rate, 30-year fixed. And the total payment on the, in this case, on the fixed rate mortgage would be approximately $600 a month for principal, interest, taxes, and insurance. And your IRA could lend additional $30,000, $25,000 for the equity component for down payment, and $5,000 to close at 12% interest only loan. That loan has interest only payment of $300 a month. And the financial friend holds the title and collects $1,000 option fee for the option that they sell. And let's say the rent on this property is $1,000 a month, which is typical and common. And the $1,000 a month rent, of that, $600 a month would go to pay PITI, principal, interest, taxes, and insurance on the first lien mortgage. And then the second lien mortgage would collect the bulk of the remaining cash flow, say $300 a month, and say $50 a month went to a financial friend for keeping the property in their name. $50 a month went into repair reserves. So in this setup, majority of the cash flow goes as a great payment to the IRA for making the loan. And if you consider the rate of return 12%, it's a great rate of return. On top of that, the IRA with a $1,000 option with a strike price of $105,000 controls tremendous upside on the property. What does financial friend get for this? Well, what they get is they get a little bit of cash flow, $50 a month. They get $1,000 consideration. And for somebody who is in a position where they wanted to cash out, they wanted the liquidity, it's a perfect opportunity to get more money at a closing instead of selling the property, paying a broker commission, paying transfer taxes, and winding up with less money that they would get in this case. It's a win-win both ways. It's a very powerful concept. And more folks trying to get these investment properties, call them turnkey investment properties, worth about $100,000, renting at about $1,000 a month. And this is an opportunity for their IRA to participate in this property without the UBIT tax. So again, it captures the cash flow through a second lien note. and it captures the upside through the option on the property, and the financial friend has financial benefits too. The only drawback is that name is on the mortgage. If for some reason there's a default, they need to be concerned. But in the case of everything performing, the financial friend benefits tremendously from the benefits from they're getting liquidity immediately, they're getting ongoing cash flow, and they have no skin in the game per se. All their money have been taken out. So it's a win for them, and it's a win for the IRA. I hope this makes sense. Let's compare this to...
Hey, Mike, can I interject one thing?
Go ahead.
So one of the things I was just going to say, and you and I have talked about this before, but in the Internal Revenue Code, one of the exceptions to an investment that does not have UBIT associated with it is, of course, returns from a loan. And so part of what...
Interest is tax-free. Interest is not subject to UBIT.
Right. So what Mike's describing really makes a lot of sense from an Internal Revenue Code perspective because it's one of the exceptions. So I just wanted to pop in on that.
Yeah, I appreciate clarification. So what this technique did, it converted kind of equity income from a ownership of real estate into a debt income, into income on a promissory note, interest income on a promissory note. And that's the beauty of it. That is not subject to UBIT. And it captures bulk of the cash flow, and it politely says to the Uncle Sam, I am very sorry, but I don't want to pay UBIT tax. So that's the technique. And then the capital gain, what the option is going to capture, the appreciation when the property is sold, the capital gain is not subject to UBIT either. With the leverage, it will be subject to the degree of the leverage. But the IRA never owns the property. It owns the option. At a closing event, when the property is sold for $200,000, that option is worth $95,000. At closing, the option has to be paid off. And it becomes an appreciation of the option, not ownership, due to not capital gain subject to UBIT tax. That's the difference. Again, all the cash flow is captured through second lien. All the appreciation is captured, or wide majority of it is captured through the option. So let's compare this. There's another interesting angle to this. If you try to go to a bank and you want to borrow a non-recourse loan, basically your IRA, not you, but your IRA, comes in and says, I'd like to buy this property, and there are non-recourse lenders. They say, okay, wonderful. Nobody can guarantee our loan. Our only collateral is the property. So I am the banker. So what would I do? I would say, well, I'm going to give you less money. So the LTV is lower. The non-recourse loans typically are offered today at 50 to 60% LTV. I don't know too many non-recourse lenders, if any, that will make loans over 60% LTV on a non-recourse loan. The second thing that happens, the interest rate goes up. So if the normal 30-year mortgage is at 4.75, then the non-recourse loan is likely to be 0.75% high, if not more. Sometimes these non-recourse loans are higher by 1.5%, 2%. I've even seen that much of a difference. So non-recourse loan could be significantly more expensive. And virtually all of them are on the 5/1 arm. You never see them as a 30-year fixed. Compare that to a traditional loan that your financial friend can obtain, or they have already obtained, and you are giving them an exit strategy. And they have, typical an investment property, Fannie Mae, Freddie Mac backed loan has a 75% LTV, better rate, and better terms as a 30-year fixed versus 5/1 arm. I hope this makes sense. So here's an example we talked about. Let me just kind of spell it out. So $100,000 purchase of a rental income property. Rent is $1,000 a month. First lien mortgage is $75,000 with a PITI payment $600 a month and net cash flow $400 a month. The down payment needed on this property is $25,000 down payment plus $5,000 closing cost. Roughly $30,000 are needed. And the second lien from the IRA to the financial friend is $30,000 at 12% simple rate and the interest on $30,000 loan is $300 a month. So the remaining cash flow of $100 a month is split as 50% repair reserves, which is about reasonable on this type of property, and $50 financial friend gets it for maintaining the mortgage in their name and accommodating the situation. And then the option that gets purchased has a strike price of $105,000, and it's a 30-year option with the right to extend if necessary for a small fee, and all the upside is captured by the option. Now you're going to ask me the question. The most difficult question is, who would sell you this kind of an option? It's a great option for $1,000 for 30 years with a strike price of $105,000. Well, nowhere in the IRS code it says what is a fair price on an option, number one. Number two, if they didn't get that loan per se, they would never have an opportunity. The IRA gets essentially an opportunity to buy an option because they're providing all the money for the deal. So if you think a little bit about this option does look like a very attractive price. But again, nowhere in the IRS code it says you have to make stupid investments and buy stupid options. You could buy a great option. So from that perspective, I believe it's absolutely fine to get this kind of an option that has 30-year lifetime at $105,000. And again, this is not a bogus transaction. It's a very legit transaction. There are plenty of life cases. And the person, this financial friend, has tremendous benefit. They have no skin in the game. They have ongoing cash flow, and they'll get a little bit of money on resale as well. So this is a very powerful concept. And I strongly believe in it. I've used options in the past, and I use promissory notes and loans all the time. Again, this is my personal opinion. Obviously, consult CPA or your attorney, but in my opinion, this is 100% good. Let's compare and contrast. So the financial friend scenario, there is no UBIT tax on the operating cash flow. There's no UBIT tax on capital gains. There are better terms on mortgage and rate. In the IRA direct purchase and non-recourse mortgage scenario, there's a UBIT on operating cash flow to the degree of leverage. There's a UBIT tax on the capital gains to the degree of leverage. And then there are worse mortgage rate in terms. It's a very significant difference. I hope you understand. Let me run through the presentation and I'll open more for questions. So why invest in general if you have a self-directed IRA or not? Why would you want to invest in the deeds of trust or mortgages or promissory notes? Well, the simple reason is that it's a very flexible risk-reward ratio. You can get great rate of return. This is an example. You could make 8 to 15% annually. In the example that we just gave, IRA was making 12% annually. It's a cash flow without ownership. You've heard about tenants and toilets. Well, if your IRA is a lender, it doesn't own the property, it doesn't have to deal with tenants and toilets. Returns could be tax-free. Well, they're tax-deferred, and as Clay mentioned, depending on the type of IRA, you either pay taxes before or you pay taxes after. If it's a Roth IRA, it paid the taxes before. There is no taxes on withdrawals. And risks could be identified, managed, and mitigated when you're making investments in the promissory notes or mortgages. I want to say a couple of words about our funds. Just again, this is for educational purposes only, not soliciting anything. And this is not just our funds. This is also, the concepts are very similar for many other funds. And my book covers a lot of these concepts. So if you have an opportunity, get the book. In a minute, I'll talk where to get it. So funds provide instant diversification. So when you invest in a fund, typically what happens, you own units or shares in the fund, and fund owns parts of many investments. And the consequence is you achieve diversification. Even with small amount of money, you could own pieces of a lot of assets and be diversified across a portfolio of income generating assets. The investment is passive. You don't have to do anything, just make an investment. You don't need to worry about ownership, no tenants and toilets per se. You're a passive investor. You're benefiting from a fund investment strategy, whatever it may be. you're benefiting from the management experience and track record, and you're benefiting from fund administration and reporting. The difference is if you own a property, typically you have to, depending on how you own it, but you may have to file taxes. If IRA owns a property and there's a UBIT tax due, you have to file. When you invest in a fund, you will most likely not have to report anything. Your IRA will get an annual statement, but most likely no reporting is required. We have two main funds, TF Investment Fund 2 and Tampa Opportunity Fund LLC. TF Investment Fund 2 is purely income fund. It only invests in hard money loans for fix and flip projects. And Tampa Opportunity Fund is a growth and income fund. It has investments in both, in hard money loans and in long-term value-add equity projects. So let's compare individual deal versus fund investing. Diversification is much better with funds. Liquidity, what's interesting is people talk to me about liquidity. So liquidity is ability to cash out your investment. So when you buy a single property, you put all your money in one basket. Your liquidity is very limited. You can get all the money out when you sell that asset, or you're stuck. With a fund, liquidity is much better. Typically, there are lock-in periods, and there could be redemption restrictions. But with that said, the liquidity is much better because the fund has, generally speaking, and again, it depends on type of a fund, much better liquidity, and you can redeem your investments. Your involvement. When you own a single property, you're involved. You'll be the landlord. Whether you're managing the managing agent and the managing agent dealing with the property, you still have the involvement. Risk tolerance is also different. Some people have much higher tolerance for individual assets, and some people are perfectly happy with that, and some folks would prefer a fund. And the amount of investable capital makes a big difference too. So if you try to acquire an asset that is $1 million and you only have $100,000 to invest, it's unlikely you'll be able to acquire. But you can invest in a fund that can invest in that asset because it pulls money from many investors. Okay, I'm at your service. This is how you can reach me. Here's my email, my phone number. Podcast is bigmikefund.com podcast. If you would like more information about our funds, please email me or call me. Email is preferred. If you'd like to get the book is available on Amazon, and Kindle version is free. If you'd like a hard copy, it's $7.95 for shipping and handling. And the book will help you with a bunch of questions if you're interested to invest in any funds, because it does ask all key questions, including what are the returns, liquidity, costs, fees, experience of the management, and so on. Anyway, I'm not trying to promote the book. I'm just giving you a little bit of information because I know the book is helpful. I spent a lot of time and energy investing in this book.
And one thing I'll mention about the book, just for anybody who's listening, is just that it really is a Q&A type endeavor. And so the questions are, pointed questions about how does Mike see these things? And so he answers them. So if that would be helpful for you, I have seen the book and have read it, and it's a Q&A. So it's kind of interesting in that format.
Yeah, Clay, I very much appreciate. What's interesting is this: if you go to the bigmikefund.com and you listen to the first episode, it touches on a number of these questions. I started with the first episode, and the book was originally produced. I had a basically Q&A with Corey Boatwright, who's a good friend and a prominent real estate investor. He asked the questions, I answered, and then we transcribed that recording, and that came a book. So it's so much easier to write a book by virtue of conversation rather than typing it in. So, any questions? Any questions about anything? Let me unmute folks. Hold on. Let me unmute folks. I appreciate everybody's patience, and I need to figure out how to unmute this. Let me see. Participants. Unmute all. Okay, folks. Everybody's unmute. You're welcome to ask questions. I hope everybody enjoyed it, And if you don't have any questions, that's totally fine. It is something that folks, you're welcome to email the questions later. And but if you have questions, now's the time. If you don't, no worries at all. I hope this was productive and helpful.
Yeah, I think you and I will hang out here for a little bit for questions, but if it's time for anybody to, go about the rest of their evening, thanks a lot for joining us, and I hope it was helpful.
Yeah, I very much appreciate everybody's time. So any more questions? Yeah, we'll hang out for a little bit, and we'll let folks ask questions. You can type questions. I think they'll pop up if you type them. If not, no worries.
Yeah, I don't know if you could you guys hear me? This is Alex out in Carson City, Nevada.
Sure, Alex, go ahead.
Yeah, in the self-directed IRA where you can set up something like this, maybe this is more of a Clay question. Can I do active investing in things, I don't know, such as tax liens or tax certificates?
Yes, actually. So the only asset classes that the IRS prohibits are life insurance and collectibles. And we absolutely have folks who are invested in tax liens and other financial instruments that are associated with real estate. So yeah, yes, is the short answer.
I also like what Mike had to show here a little bit earlier here this evening, in that if I don't want to be so active, be a little more passive. I also like the idea about investing in his funding and get the high return and just let it build up. My job is just to fill in more money into the IRA so that Mike can invest for me.
Alex, thank you for your vote of confidence. I'll tell you this. So the first thing you mentioned, the tax lien investing, I know a number of folks who do this, and it's a phenomenal opportunity. And the beauty of working with self-directed IRA custodian and New Direction IRA specifically is the fact that they know what they're doing. They will allow you to make these investments. The traditional IRA custodians have no idea. I've tried to do it with Bank of America, with Citi and Chase. They don't want to even go there. So if you get your money transferred, your IRA transferred to a self-directed custodian, you have that flexibility, and not all custodians created equal. I just wanted to say that my experience has been very solid with New Direction IRA, and they allow you to invest into things like that. You know what's most interesting, and Clay and I chatted about, as crazy as it sounds, I thought IRA custodians would never come to this. Then now we allow investors to even invest in the crypto. So I'm not I'm not defender of crypto. It's it's a very speculative investment, but that's the strength of these IRA custodians, self-directed. They come in and then they enable you as the investor. They empower you to make your investment decisions. So, and back to your question. We could talk, offline. I'm a fund manager. I love what I do. I'm very passionate about it, and that's the beauty about it, is that I can deliver the returns to investors passively, help them grow IRA or non-IRA funds, and so that's what we do. I mean, that's it's both a lifestyle, and it is also a something that I found. I'm very, find something that you like, you're good at, and something that makes money. It's that golden kind of triangle, and I found it there. Before I went into real estate, I spent 15 years in software development, and it made me good money, and I liked it, but I was burned out and tired, and I was investing in real estate part-time for 9 years before I became a fund manager, and I said, this is a whole lot more fun. So, and then it started with friends and family money, and then we got all kinds of other investors. So I appreciate your vote of confidence. Yeah, reach out to me through an email if you have any interest. I'll be happy to send you the information. So thank you, Alex.
Oh, no, you're welcome. I'm just being quiet so somebody else can get a shot at asking you questions. So.
Yeah, no worries. We've run a few of these webinars in the past. I remember, Clay, we did one a couple of years back, I think. And not too many people ask questions. Later, you start getting some emails. What about this? What about that?
Yeah, sometimes it takes a little while to have the information percolate. So you and I are both, educators for the long term. So anytime you want to ask questions.
We'll keep it open for a couple of minutes. I'm sorry, go ahead.
Oh, I'm sorry. If nobody else wants to ask, I got a bunch of questions. So, please butt in. I'm self-employed. I got my own S corp. I'm in the real estate business, but I want to put away more money into something like an IRA or a SEP. So any one of these things you showed here this evening, I can go either IRA, whether Roth or regular, or a SEP.
Yeah, I'll let Clay answer the question because it starts with the different IRA types and the contribution limits. But the technique, you could use any IRA. You could use SEP IRA. You could use traditional. You use Roth. It can make a loan. So what the type of IRA makes no difference as far as the technique is concerned. But how do you get the money in the Roth IRA, which is the most preferred IRA account, is something that Clay probably can answer because there are contribution limits for Roth IRA, for SEP IRA. Clay, could you elaborate a little bit on that?
Sure. Well, one of the things that's anybody who is self-employed or has one of the employer accounts has the ability, of course, to make larger annual contributions. So your SEP, obviously, I think in tax year 2017 is $54,000. At the moment, and this started, I believe, in 2010, the legislation for conversions changed. So you actually have the ability to convert from a SEP or a traditional to Roth at any level you want, and it doesn't matter what income you made. So it's as liberal as you can possibly get. But the core answer to your question is yes, the account type really doesn't matter. It's oddly enough, the IRS does not dictate to IRA providers which assets they handle. And so banks and brokerage houses typically chose, hey, we'll do the custodianship for your IRA, but you have to buy the things that we sell. So a company like ours kind of took the other approach, which is we'll learn the bookkeeping for all these alternative assets and we'll charge you for our bookkeeping fee. And so we're able to offer a suite of investment opportunities that they don't, simply because it's not their wheelhouse. So yes, all those account types, whether it's SEP or simple, solo 401k, traditional IRA, Roth IRA, or HSA, we handle all of those, and all of those can invest in all the things we talked about tonight.
Clay, I commend you on revealing the backdoor contribution technique. What Clay just mentioned to you, it is known as a backdoor Roth IRA contribution because most people don't realize what it is. So while we're on the call, we'll chat a little bit on that. So Roth IRA, I think, has a limit how much you can contribute, even if you're on the income bracket that allows you to contribute. They do have a limitation. I don't know off the top of my head what's the limitation where you can't contribute. But if you're able to contribute to SEP IRA, you can get a tax deduction on the contribution and then immediately convert the contribution to a Roth IRA. That technique is known as a backdoor contribution. So if you wanted to get your money into Roth IRA, and you can contribute to SEP IRA, by converting it immediately, you wind up with all the money going to Roth IRA. You lose the tax deductibility benefit because you will pay taxes on the conversion, but you get a deduction on the contribution. So it'll be a wash. But that's how you get the money in the Roth IRA. Does that make sense?
Oh, yeah. That's nice.
Yeah, and the contribution is a function. I think this, as Clay mentioned, there's an upper limit of, you said 54,000. I thought it was 52, but might have gone up this year. So 54 is the upper limit. And then the secondary consideration, I think, is a quarter of your income. So you cannot contribute more than 25% of your income. So it depends on how much money you make. You have two limitations how much you can contribute.
And is that income based on what the S corp brought in, or is that the income based on what I pay myself from the S corp?
It's a CPA question.
Well, I can tell you that generally speaking, it's the corporation's revenue. So, for instance, especially if you're self-employed, generally speaking, you're probably going to have revenues in the neighborhood of $250,000 in order to contribute the annual maximum of $54,000. And there's a couple of reasons for that, but that's the general calculation. But yeah, as Mike said, it's based on a percentage of the revenue from the corporate structure.
Yeah, I'm not a CPA, again, just a waiver. If you're
Me either.
Yeah, if a corporation brings in, say, $250,000 in gross income, it's going to have deductions. So it's sort of a net. The net income for you as a self-employment, or whatever that net income is, that's what becomes what's eligible for the 25% contribution calculation. But there might be other complications depending on type of income. So it's really a CPA question. Directionally, that's what it is. You make 250,000. You have 50,000 expenses. You show 200,000 in net income. You could probably contribute up to $50,000 of that. However, if you have a bunch of other deductions, and I don't know exactly, but it'll reduce your deductibility. So I believe it's not as important to contribute the max, but to contribute. So it's not a game of perfection. Maybe one year you can contribute more, another year you can contribute less, but if you contribute every year, you're moving in the right direction. That's basically the philosophy, at least what I think of it.
Okay.
Shoot your other questions. We got a couple of minutes. We'll take another one or two questions if you have them. Alex, you want to go ahead and ask another question?
No, I have your contact information. I've been searching for something that's self-directed. My frustration in the past was trying to find somebody to allow me to do something like this self-directed wise, and they're all telling me you can't do that. The IRS won't let you do that. This, that, and the other. I think it's from a lack of knowledge. So this is really cool that I was able, through a friend of mine here, also on the call, that connected me to you. So I'll be in contact with you guys.
Yeah, I appreciate that. Again, New Direction IRA is the custodian that will enable you. So just reach out to them, and they're great. The website is, Clay's very, very modest, but their website is phenomenal. They have so much educational content, and so I think we are probably done. Thank you very much for
I'll let you sign off, Mike, but thanks a lot for having us. And I know that you arranged the the technology, so I appreciate that. And for everybody who joined us, thanks a lot for spending your evening with us.
Yeah, thank you kindly, everybody. Have a good evening.
Okay, good evening.